Hello class 3367 CIS. This is Ed Sorrentino, and as some of you guys don't know, which I don't expect you because you don't know me, I'm actually an accountant at an insurance brokerage, which is pretty cool at my age, I would say. And one beautiful day, I think it was a Wednesday, my boss, whose name I will not say for privacy purposes, obviously, asked me to analyze a real estate investment opportunity, two of them to be particular, so that is what I will be basing this midterm project on. Alright, so let's just dive right into it. This is property 1, option 1. These properties are located in Center Reach, that is in Suffolk County, New York. Okay, the total asset valuation as price is $1,927,500 roughly. So obviously I had to allocate the assets based on their units, which I did do here in the annual P&L projected. And obviously I had to account for the revenue and your total operating cost. And I did say operating cost, but this does include your taxes and other operating expenses. And I also included a line chart to show what we would be looking here. Obviously everything is going up because I did include appreciation, which is very important in an analytical decision. This is showing you over a 9-year period, and this will obviously allow my boss or any potential investor to clearly see what type of revenue, net income, and expenses will be every single year annually. Alright, so property option 2 includes Mastic apartment units. That is obviously located in Mastic, New York, Suffolk County. And there are 8 units, and I obviously had to, like I said in the other property analysis, I had to allocate the assets accordingly. So I just simply took the $1,500,000 asking price and asset valuation divided by 8. And then I also accounted for last year's revenue and applied it to future revenues with appreciation, which I will get to. And then obviously I also had to account for the expenses, which does include taxes. Net income is $128,000, huge difference from property option 2. And if we look at the charts, that will obviously show our investors, or any investor, including my boss, what type of net income, revenue, and expenses that we'll be seeing on an annual basis. What I also like about this property is that it is a rental property and it doesn't have many different types of options that property 1 has. This is just rental property. People are already renting this property out, so what you're going to do is just simply jump right into the operating cycle with your name on it and just start collecting the revenue, which I do like as an investor. Alright, so now as an investor, we're going to need some money to invest in. Unless you got great liquidity issues or you got a golden goose in your backyard, you're most likely going to need to take a loan for something worth $1.5 million. That being said, I did amortize 3 different type of loans. Loan option number 1 does include the remaining balance ending at 2050. That is a $1.5 million loan, 4% APR, 30-year loan terms, and that conversion ratio to interest to principal does change around 2033. Now what I did include were 2 different types of other loans to reduce the interest payable to the bank. Loan number 2, Automation 2, as shown above here, is the $1.5 million loan with $50,000 deposits annually out of the investor's pocket. Loan number 3, Automation 3, is $100,000 instead of $50,000 deposited annually, obviously reducing the interest payable significantly even more. Now, if you look over here, I had to take away the $50,000 and $100,000 principal loan deposits because I did want to show the visualization of the conversion ratios, interest to principal, more clearly. Obviously, that messes up the data. Alright, CIS class, we're going to be going over investment opportunity 1. I'm assessing this as less risky compared to the other 2, and I will explain why. So we're going to be purchasing property opportunity 2, the Mastic rental units, for various reasons. Number 1, and primary reason, net income is significantly higher, and its net income to asset valuation is significantly higher as well compared to property 1, which is the Center Reach properties. So that being said, we're going to be purchasing those, and let's just take a look at real quick at how our net income and revenue is going to be appreciating over time, and it's significant. And not only is the net income and revenue going to be appreciating, but the asset valuation of real estate is going to be appreciating as well. But in 10 years, in 9 years, your asset valuation is down 1.8 million. So how are we going to be purchasing this? We're obviously going to be using a loan, automation loan number 2 to be exact, and we're going to be using this because this significantly reduces our interest due to the bankers, which obviously increases our net income on the long run as a personal. And we're going to be showing this as a visualization here on the scatter line. And what this does is it's showing you your principal amounts and your average remaining balance on the scale, and your $50,000 deposits annually made. And then also on the bottom here is a map, so you can also see how you're doing in the sum of year 1. You can see your year 2, and then obviously if you click here, you can see your asset evaluation as well. Okay, so now let's assess investment opportunity 2. I've assessed this as fair risk. We're going to still be purchasing property 2. However, instead, we're going to be including a secondary investor at 10% on all rights, the dividend distributions, and asset appreciation valuation. The buy-in rate to this is $250,000. Now, what we're going to be doing with that $250,000 is applying it to automation loan number 2 right off the bat. So as you see over here, you can obviously see that this visualization shows our principals on the left, on the y-axis, and our average remaining balance on the x-axis. And this big increase over here is the $250,000 being applied to the loan right away. Now, as a potential investor standpoint and as the primary investor standpoint with these two charts is that you are able to see your dividends and equity appreciations go up over a 10-year standpoint. Excuse me. Now, as a potential investor, you want to be able to see your dividends and equity evaluations over a 10-year lifetime for the raw data purposes. So what I did include was a table down here that does show the numbers nice, crystal and clear, so you're able to distinguish between your equity valuations over a 10-year time period and your dividends evaluations over a 10-year time period as well. Alright class, so now let's take a look at investment opportunity 3. I'm assessing this as the most risky investment strategy compared to the other 2, and I will explain why. The reason that is more risky is because instead of taking out a $1.5 million loan, depositing the $250,000 with a secondary investor, and depositing $50,000 annually every year, we are now including automation loan number 3, which does include the $100,000 annually deposits towards the loan principal. Now what that does is that it significantly reduces the interest paid to the bankers, which we don't want to pay these bloody bankers any more than we have to, and also it reduces the average remaining balance significantly over your loan period or your loan term dates. And like before, and like strategy number 2, we are including 10% buy-in at $250,000 at the secondary investor, the potential investor, and that gives them the right to claim 10% to all distributions as well as asset valuations and appreciations. And I also included the raw data like I did in strategy 2 and a chart to clearly see the numbers of appreciation per investor. Alright class, that's it. That wraps it up. Stay safe. Hopefully you'll get a raise. And don't get the corona. Take care now.